Welcome to today's event where we have the pleasure to present Columbus. To help us through today's presentation, we are joined by CEO and President Søren Krogh Knudsen and CFO Brian Iversen. We are going to talk about your Q1 results, the expectation for the rest of the year. You delivered these results last week, but let's get some perspective on your performance here in the first part of the year. It looked pretty strong, but I will hear you whether you think the same. As always, ask questions in the box down below. Do it in English, do it in Danish, and if in Danish, I will try and translate to the best of my ability. But for now, I will hand the call over to you, Søren.
Thank you very much, Michael. Thank you, and good afternoon, everybody. Nice to meet you. Yeah, as Michael just said, we'll be going over the Q1 2024 financial results, doing a bit of commenting on them. And the structure is going to be quite simple. I will cover the financial and operational highlights first, and then Brian will cover the financial performance for the first quarter in a bit more detail, and then we will have a Q&A session towards the end, and that should set us up for a good half an hour. So if we look at the Q1 first, I think we can start by making a general overall comment, and that is that we are overall pretty pleased with the outcome of the first quarter. But there are, of course, nuances to this, which we would like to go through with you during this presentation. But let's just go through the top line numbers as they stand. First of all, the revenue, we had an increase of 14%, corresponding to 444 million for the first quarter. The EBITDA ended at 55 million, which is an increase of 41%. That there was an uplift in this number, which we'll come back to, which was a non-operational event, the settlement of a legal dispute. The EBITDA margin was also positively affected by this, landing at 12.4%. So an uplift by this one-off event, and then a slight headwind from the Easter holiday. So I think for those of you that follow consulting companies, you might have heard this before, but the Easter can sort of shift between the first and the second quarter. And this year it was in the first quarter, and that leads to fewer production days compared to last year. So Easter alone counts for 2 days, and then there's also sort of the 2nd of January. How opportune is that in terms of providing a full work week in the first week of the year? And that was a 1-day deficit for this year. So it's just basically a timing which is back and forward in terms of the Easter. Our recurring revenue grew by 18%, which we're very pleased with. So we have been aiming at getting that growth percentage up to at least the level of the combined revenue growth, and preferably a little bit higher. So we would like to have a slightly higher share of revenue coming from recurring revenue. And for those that are new to us, just explaining the types of revenue we have. We have a large part of our revenues are basically consulting revenues, and they are largely based on time and material. But we also have these recurring revenue contracts, which are you could call them, we call them evolve contracts. They're typically customers where we've done a huge piece of installation work, implementation work, and then we have a role in monitoring and optimizing and future-proofing that solution going forward. And that is on a fixed or recurring revenue, typically multiple year contracts. Also here we have in this bucket, we also have a little bit of revenue from subscription and things like that. So profit after tax landing at 35 million, an increase of 87%, and then the cash flow slightly down from last year, although positive. And again, I think Brian, you might comment on that, but the 31st of March was on a Sunday, which means that I think a lot of customers took the opportunity to just do it on the following Monday, which means that we receive it in the second quarter, and that's how we do it. But I would say that in terms of our accounts receivable, which is normally Brian's domain, but I keep an eye on it as well. We have a very, very clean setup, so we don't see any issues at all, but just a small timing effect there. Then in terms of efficiency development, this is probably the most important KPI, as you know, for a consulting company. We have been steadily increasing our efficiency percentage quarter compared to quarter, but also quarter by the next consecutive quarter. We're landing at 62% here, which you can see is actually not for the first time an improvement in a long time. And I think for us it means two things. First of all, we're starting to get up into slightly thinner air. So compared to when I started, there were some very easy things I could do to improve this metric. It's a little bit more difficult now, although we do still think we have some points to improve, definitely. And then I think some of the things holding us slightly back now, we'll come back to that, is the actual business performance in some of our smaller business units that draws down the average somewhat. Good. And then as you can see, the revenue split here, very similar to last time. You can see that our Dynamics and M3 business still makes up about 75% of the business, and then we have our the rest of our business lines with commerce as the runner-up to sort of the big two, and then our investment business lines. We'll get further into them as Brian comments on their individual performance. Good. Then I will make some very broad comments to the geographies we are operating in. As you will see also from the financial report, it's a little bit of a tale of two cities, where we have Denmark and the UK as sort of the front runners in terms of growth. We have probably, at least in Denmark, a little bit more favorable market conditions, not as such in the UK, but I think the main part of the quite substantial growth these two markets deliver is simply that we've set up our own operation, our own organization. The way we do customer development and sales is working very, very well for us. So we're taking market share big time in these markets. And then the other two larger markets in Sweden and Norway, we are, from an external and perhaps sort of more macro perspective, we are seeing a little bit more headwind. Markets are a little bit more hesitant as such, but I would caution reading too much into that. We're talking pretty small differences. But if you combine those small differences with our business unit exposure, where we have the commerce business unit is very big in Sweden and also pretty big in Norway. The commerce unit is very exposed to the retail sector. And the retail sector is probably the one where you're seeing the quickest response to macroeconomic uncertainties. So they scale back a little bit faster on investments, and that is basically what's holding our growth back a little bit in Sweden and Norway. And then I would also mention that Sweden and Norway have just been very big contributors to our growth in the past years, and sometimes you sort of plateau a little bit before you can take the next step. Otherwise, smaller geographies, we're seeing Germany performing very well, always exploring what opportunities that holds for us in the future, and the US sort of at a pretty I would say stable level. Yeah, and then let's go to just a few other operational things. We've taken the opportunity to, as you can see here from the pictures, to upgrade our office facilities a little bit, which is important given that we're a people business, and we're starting to get more people into the offices. In Norway, given that we've grown so much since it's years back since we took the office we had, so we were really under capacity. So we inaugurated a new office there in early January, and very recently we took the chance of moving our main UK office into to the center of Nottingham, in a new and very nice facility, which was simply a better working environment. So and our people are very pleased with it, and it further helps sort of dynamics about getting people back to work, getting customers to want to meet up at our facilities when we have planning workshops, when we have strategizing sessions with them. So having this sort of brings our strategy to life well. We further invested in the enabling life science readiness, as you can see. This is about our new industry vertical, life science. For those that have followed us for a while know we were big into manufacturing, we were big into food and beverage before, we were big into retail. We continue those. We wanted to add a fourth one, which is life science. We're actually landing quite a lot of new customers into this segment, but to have sort of the long-term growth we want, there are a few new things we need to learn in terms of how to address them. What are their the regulatory requirements that are separate to them. Some of them they share with the rest of the FDA, but there are of course very specific things we need to build capabilities on. So we've set up a global team which works with the enabling of this customer segment going forward. We have second bullet, almost finished the integration of Endless Gain, small acquisition we did in the commerce space. This was very fast. It wasn't the biggest. It's been very successful. It's been very easy to integrate. People are mainly sitting in the UK and India. They have been integrated into our commerce team. They specialize in what's known as click rate optimization. We didn't have that capacity or competence in-house before. We now do. And particularly Sweden and Norway are pulling extra demand and will allow us to sort of grow that further. Yeah, and I think with that, and to have questions at the end, Brian, I'll hand over to you.
All right, thanks, Don. Then let's have a deeper look at the business line. First, revenue development for the first quarter. And as Søren also mentioned, it's quite a mixed picture. But overall, we're actually very happy with the 14% growth or 11% organic growth for the quarter. Also seen in the light of the industry and some of our colleagues out in the market. And secondly, just to mention, last year I talked a lot about the FX impacts compared to previous years. This year it's fairly stable, so we cut that piece out. It's minor impact we see right now because the Norwegian and the Swedish crown keeps on a steady low level, if we can say that. But overall, we're very happy to see that our two, what we call the ERP cloud business line, Dynamics and M3, is off to a very strong start of the year. This is around 75% of our business and is key for delivering during the year. So that's very positive. Then, as you can see or have seen, that we have some of our strategic smaller business lines, digital commerce, data and analytics, or data and AI, as we call it today, had some headwind in the first quarter. They are mainly operating, or they have a big part of their business in the Swedish and Norwegian market, which Søren also commented on, is seeing some challenges. And especially digital commerce is heavy in the retail sector. That let's say looking at each penny they are spending at the moment, fair enough, and that do sometimes impact the the speed of new projects and when they start. So I think that's the few comments. I think again I wrote it in the bullet. M3 is back on a growth track. Some of you might remember last year they had some challenges here and there, but they are actually coming strong out of this year. So that's really nice to see for our big team up in Sweden. All right, that was the revenue, and if we then have a brief look at the business line contribution, that's a key measure for us towards our business line executives that is running each business line. Again, and of course it's heavily related. If the revenue is healthy, it's strong, it falls down to the bottom line. And again, Dynamics and especially M3 is off to a solid start, and both of them is running on the close to the healthy around 30%, which is definitely some of the internal targets slightly that we are setting for our business lines. Digital commerce and data and AI, as mentioned before, saw some headwinds, and as we have a lot of valuable consultants, all know that it's not like getting offboarding and onboarding. That's not something you do during a month or two. So it's a constant optimization and believe in what is the right and best setup. But of course, we are taking that seriously. We are looking at it and see where we can optimize and if needed, smaller restructuring. Then at the end, I might put a comment on security. As you know, we acquired that a year ago, and I think as some of you might have read as well, we strongly believe in this is an important leg to our offerings. But we have seen some challenges in getting that up on a fair, profitable level. But again, we have some solid plans, and that is high on Søren and my agenda as well for the coming quarters, definitely. But overall, we are happy, and as Søren also mentioned, we saw the Eastern. So in the consulting industry, to compare like for like with Q1 last year, you might need to adjust for the Easter holiday and the loss of revenue days that we saw in Q1. And if I do a rough calculation, it is around 10 million or 2 percentage points on the bottom line, and that you can of course discuss back and forward and calculate for days in Excel. But that is a thumb of rule number that we use internally. All right, next slide. That's briefly about efficiency and recurring revenue, some of our KPIs that we follow very closely. Søren talked about efficiency. So let me just briefly comment on the recurring revenue. It keeps on around 13% of our total revenue, which is okay, but as we also have mentioned earlier, that is an area that we definitely want to explore more and are putting a lot of effort in growing. It's a nice and strong service to our valuable customers, and after implementing a new ERP system or whatsoever, that we can continue and give them the right support in that. So we push on that, but again, at least they are growing in the same line as our general consulting business. Last slide from my end is the revenue split per market unit. Again, to mention on it, we saw again a very strong Denmark coming out in the Q1. This is including security from last year, so it's around 26% organic growth, which is still very healthy, and we really gain market share in Denmark when we look at it a bit deeper. Sweden and Norway a bit flattish, which is it's not as 100% as expected, but again, in seen compared to our colleagues out there and compared to the market in general, I think it's a fair achievement that they keep it good and flattish. US is very small, so a few projects coming in and out within a quarter, of course, affect that quite heavily. But overall, as I mentioned in the beginning, we are very satisfied with the solid growth. So if I end that up in our outlook for 2024, we still maintain the outlook as we set out when we released the annual report for 2023. So organic growth of around 8 to 10%, and EBITDA margin of between 9 to 10%. Yeah, good. I think that leaves some time for questions, unless you have something.
Yeah, but let's jump to the questions. Let's start by this Easter effect. And I think you mentioned now 2 percentage point was the effect. So that was one of the questions. So if we can just bridge it, if I do understand you underlying without the, if you take away the positive effect, one-time effect, and then add the Easter effect, are you then landing around 10% or something like that in the quarter? Is that a good ballpark?
That's well calculated, Michael. But that's okay. Around the 10% point. If we adjust for Easter.
I know there will always be swings there, but
that's correct.
Yeah. And the second part of the question is, will you regain that? Will that be a positive effect? Is that automatically regained? You know, when you get more working days, our contract fulfillments and so on. So it will be a boost to your second quarter. Is also a question automatically. Is that correctly understood?
Yes.
Yeah. So the 2 days for Easter, will be regained so that's what switches back. The 1 day lost compared to last year in calendar week 1. If you look back in your calendar for last year, you will see that it was a really, I think, I don't know if it translates well to English, but it was an employer's Christmas or whatever you call it last year. So basically the 2nd of January, which is the first working day in 2022, was a Monday. So you kind of get 5 full bang for the buck, and now in 2023 you're losing 1 day in the first week. You don't get that one back.
No, perfect. Then there's a question regarding M&A targets. Any candidate in sight? I know you can't answer that fully, but you can talk about your pipeline or maybe the areas where you need to maybe strengthen your capabilities.
Mm-hmm. So I can certainly say that there are candidates in sight, and the way, so we do have the sufficient size. That means that we have a dedicated function that continuously looks for new opportunities and maintains an actual pipeline of companies that we talk to and that we develop, just like you would a sales pipeline. So we have some that are in very early initial dialogues. There are some we follow up on, and some we go further and further with. I can't comment obviously on sort of how advanced we are with some of them, but M&A certainly still forms an important part of our strategy going forward. I've said a little bit about my considerations before. I can perhaps just reiterate some of them, and they go something along this. Is like, I'm very focused on integration and successful integration. We can see how difficult it has been for us to integrate ICY. We can see how successful we were in terms of integrating Endless Gain. So if you acquire companies in the consulting industry, it's all about the integration. You're not buying an asset, you're not buying a factory, you're not buying something where, it's essentially, it's a people thing. So integration is super essential. So there are some considerations about that, is that we can't do too many too small, because there's a certain entry level fee in terms of our own management effort, which is the same regardless if we require 50 people or 500 people. So we have a consideration there in terms of also evaluating slightly bigger opportunities. There's then the usual distinction, I would say, where we need to be very mindful of why are we acquiring. Is it a capacity game where we simply just in a successful market unit in Sweden or Denmark, just saying, okay, we're very successful here, let's get more capacity. That's one type. The second type is that we know that we're very successful in one business unit in one geographical market, so there's no reason we shouldn't be as successful in a different geography. So we'll look to make a head start because we know what we're getting into. That's also that's the second one, and perhaps the second easiest. The third one, which is security, and that's getting into a completely new competence, which security was for us in this type of security. That's the most difficult one, but sometimes we need to do it, and those are sort of the three lenses we evaluate on.
Perfect. Then there's a question here.
Might be a politician's answer, but it will always be that.
Yeah, but I can't get more out of you if you don't want to break the insider rules. So that is perfectly. Do we need to work with capacity adjustments to get your guidance to catch your guidance this year? Maybe the question was because your margin was below, but that sounds like the Easter effect. But maybe also because you could see that the efficiency was maybe not that strong in some business lines.
Let me start, and then you can follow up, Brian. So I think the first answer from me would be in order to reach the guidance, I don't think we need to work with capacity as such, but will we work with capacity? Absolutely, and also with some capacity adjustments. And there's a difference now to last year in the sense that the two very big parts of our business, Dynamics and M3, that makes up 75% of our line, but much more of our contribution, are running very healthily, and we have full capacity flow across the borders within those business lines. And then obviously there's an overcapacity in some of our smaller business lines, which we're continuously having a look at, and what it comes down to here is that these are future growth engines. So we're not just going to take capacity out to optimize our results on a 3 months basis or 6 months. It doesn't work even that fast in the Nordics because of other things. So we're quite committed to these areas. But that being said, of course, we're mindful of that when we do. And what I have done since I joined is I've placed a number of strategic bets. Some of them are already working, some of them we expect to be working. Of course, when you do this, not all will work, and then obviously you need to adjust once you've seen enough for that. And we will always be doing that, and it's not linked to sort of the guidance for this year. And then the counter question could perhaps be, well, why not just address everything that's below 64 or 68% straight away? Well, that's because I have an expectation that can contribute positively to our future growth. And then, of course, Brian has the EBITDA 15 plan, which I started and asked him to complete, and says, yeah, but there's this one as well. That's the balance we continuously work towards. So we need to have the growth and the EBITDA positive development as well. Brian, I don't know.
Yeah, but I think you said it. I mean, it's always on the agenda, and as Søren said, it's easy to adjust your capacity, but then you also adjust your capability of gaining revenue in the future from very strong consultant that you have invested in. So it is, of course, a constant balance, and also to look a bit into the future and see what do you have of project, what is the pipeline, what is coming up, etc. So, but yes, the short is probably, of course, we always look at it, and yeah.
Then there's a question around the cash flow. I think you also answered it, that I also heard that from some of the other companies that the working capital because of this Sunday. So there's a question here. Do you expect the cash flow to be around the same level as last year?
Yeah, I think short answer is yes. We had a cash conversion of around 65% last year, and that is what we are working towards. The only little thing that I see, but it's really minor, is of course the bigger project and customers that we get, the tougher they are on payment terms. That's how it is. But we're working hard on that, but yes, we expect the same thing. And the Easter was ending, or the March was ending on a Sunday, and as all good citizens, then you don't pay 5 days early, you pay 1 day late. I think we did the same. So, but that is how it works. Yeah.
Then there's a question here. I will just ask it. Is the drop in CM dynamics due to increased competition in the market?
No. So I think you're referring to the 1 percentage point drop from 30 to 29. Yeah. So the overall contribution, of course, has grown with the revenue, but the no, I wouldn't say it's down to the competition. We're very mindful of now with the fast growth in Dynamics that we go into the right contracts, and we're also sometimes walking away from business that doesn't contribute positively. So what is it? I think what I can say is the following. First of all, around 30%, then it's good. Like then a lot of things have to be good. Then there are 2 things holding us back from even going past the quarter-on-quarter comparison. One thing is that actually not all business units were fired. Despite the fast growth, you will be able to see that Norway and Sweden are just picking up pace again. That would have contributed positively. And I believe also, as I said before, we have a very, very healthy accounts receivable. But in the first quarter, Brian, correct me if I'm wrong, in the first quarter we had the first small write-off in a long time. That yes, exactly, a Norwegian customer that went bankrupt. Not a big amount, but when you're into that small, overall, I can say I'm very pleased with. We have always. It's actually one of the things which I was pretty content with when I joined Columbus, was that the accounts receivables were run quite tight, but we've improved even further on it, and we chose, as part of all of this macro geopolitical things, to be even more mindful of it. So we have very few losses, and we have very few issues with bad debt. But obviously we have more than 1,100 customers across these geographies. Sometimes we will experience a bankruptcy,
and that of course can have a small effect. I will let you off the hook by asking a last question on the guidance. I need to do that as an analyst. So if we correct it, you got 10% in EBITDA margin. I know ballpark. You were above on the organic revenue growth. I think some of your colleagues in the market indicating that Q1 was the tough one, and they were seeing better outlook looking into the second half of the year. So you kept your guidance. Maybe another way to ask that: how sustainable is this ERP cloud growth? Is it a too good quarter, or is it actually you performing well, being in the right industries, and you can see that continuing? Because I think that's there maybe the answer lies a little bit. Is this sustainable, what you saw here, or and are you on a good growth trend? Are the right things dragging? Are it working in the ERP cloud? I would say, and would that continue? I guess that's the second question. And of course, regarding your guidance, you didn't upgrade it. I know it's early year, but it seemed you are looking very good.
In terms of the 2 big ERP units, I think we are both Brian and I are feeling pretty confident. So we look at the pipeline as well. What do we have incoming? What's the order backlog? Which big projects are coming towards an end? And but these are fairly large business units now, and you tend to see that when you have a number of big customers, then it kind of evens out, and then you have a small growth in it. So I would say to that, it's sustainable. They are pretty big ships, and once they're up in speed, they don't just stop. On the other hand, you won't see a tripling suddenly of the growth that you can in some of the small business units because they're larger ships. So I'd say Brian and I are mainly focused on the smaller business units that we commented on before.
And just to return to this ERP, because it has maybe been a good growth area, but maybe not a high growth area. Has people underinvested in their ERP systems? Have the challenges out in the world been driving them to needing to invest more? Maybe if you can give some color on it. I know it can be hard to just mention one thing, but just to get a feel of it, because it seems like it's as you said, it's nice to fire on both your big cylinders, and as an investor, I think it's important to understand whether that's a new normal or something like that.
Well, I think so. Obviously, if we go back a few years, what's driving it? So the transition to cloud is almost complete, I would say. Now there's still a few that are running on premise, which means they have their own basically installment, and you can split them again in two. Some have done it for specific reasons that they believe that to be the right setup, and some haven't gotten around to it. But to a large extent, we've now lifted companies into the cloud. There's huge benefits in terms of the transparency and how uniform the setup can be. I think the customers are experiencing, as part of this journey, and part of our advice to them was, don't do as much coding, don't do as much customizing. So we call it adoption to standard. Most of the companies don't like it initially when you say it, because it's less bespoke to them, but it gives huge advantages in terms of lifecycle management for them. And it also makes it much easier for them to acquire companies, to divest companies, to integrate their ERP system with different, it could be transport management, warehouse management, e-commerce that we also do, all of these solutions. So I think they're just seeing the benefits in terms of business transparency, in terms of agility, in terms of security, in terms of predictability, are some of the areas where they're reaping the benefits. And then I think what we benefit from in Columbus is that we've sort of upped our track record for being the ones that it's almost like building a house. People were the past holds many ERP projects that were way over budget, way over time. We emphasize a lot on predictability and quality, and being and perhaps that's something that drives our increase in market share.
Perfect. That was nice to hear. And I know you're probably not going to comment on the guidance, but with the strong start, but maybe the last point, do you also see, as some of your colleagues out there said, that maybe there could be some better economic growth in the Nordic region, in Norway and Sweden, and maybe there could be a little bit pick up in market growth in the second half of the year with a better European economy, or what you might say? Is that also something you are feeling or hearing, or?
It's very early days in Q1, but I can certainly say now that we are halfway into Q2, that we still see a very reasonable activity level going forward. Yeah, I think I'll leave it at that, Michael, for now.
We also a little bit over time, so thank you to you, Brian and Søren, for taking us through your results, and thank you for the audience for listening in and asking questions.
Good.
Thank you very much, and thank you for all of you listening in. Thank you.